Good afternoon, everyone. Good afternoon. Hope everybody's well today. We're gonna go ahead and let a couple people get in here, get a couple minutes, give a couple minutes for people to go ahead and come in, and then we're gonna go ahead and get started. Um, Today we're gonna talk about understanding equity and debt in the corporate structure. So we're gonna kind of open that door and start beginning to discuss how equity and debt work in a corporate structure. So we're gonna give a couple minutes, let some people come on in here, and then we're gonna go ahead and get started. So, how's everybody doing today? A couple of housekeeping items before we get started. If you have any questions, feel free to use the bottom left-hand corner. There's a box with a question mark in there. Feel free to put your questions there. And from there, we'll go ahead and I'll open up a Q&A session at the end, and I'll be able to answer questions from there. I'm doing well. I'm tired. I'm really, really tired. It's been a long week, but still gotta grind. Still gotta do what I gotta do. You know what I mean? Like, the grind don't stop. So that is what it is. So okay. So I'm gonna go ahead and get started. So before I get started, I gotta do a little bit of a shout out here, if y'all don't mind. My oldest son, Brian. I know that he watches my lives from time to time, and so I gotta shout him out right now. Say a little bit of a story. My son Brian right now is a straight A student. And he is the president of his school student council. And I'm very, very proud of him. This is huge. 2 years ago, he was failing everything. And I brought him out here to live with me. I had to put my foot on his neck, get him together, teach him kind of the right thought process, the right mentality, and things like that. And, he is definitely applying that concept properly. And he is now a straight A student 2 years later. When he came out initially, he came out in the middle of a school year and he was failing everything. He finished the school year with A's and B's. Interestingly enough, the next year after that, he was mostly A's and a couple B's, and this year he is straight A's. So I am very, very, very proud of him. So Brian, I know you're gonna see this later. I love you. I'm proud of you, and you definitely showed me what's up. You made me a believer. I wasn't sure if you had got it yet. And you definitely got it. So I am definitely 100% proud of you. And I want you to hear that on the live. This is for you. You know what I mean? I'm proud. I love you, son. So with that out of the way now, this is definitely a hashtag get real woke, hashtag make it make sense, hashtag for the free. We're going to talk about understanding equity and debt in the corporate structure today. Now, here's the thing, right? I realized as I was putting my outline together for this course that I'm not going to rush through this, right? I don't want to try to squeeze this all into one discussion or two discussions, because what I realize is there's a lot of, this is understanding equity and debt in the corporate structure is the core basis of everything you're going to do, from building a business to investing to understanding the fundamentals of how, companies work, from valuation, from understanding price to earnings ratios, which we'll talk about later, understanding share dilution, understanding how debt affects the capitalization stack, or the cap stack as we call it on Wall Street. These things, this is beginning to understand the quantitative approach of analyzing a business. And if you do not understand these things, you will never be investing. You will always be speculating. And it's very difficult for you to plan a business and plan how you're going to scale, how you're going to protect yourself, different things that you're going to need to be considering when you're thinking about starting, growing, scaling, expanding. There are a number of things that go into that. And this is the core basis of that. So I'm going to take this in small bites with you guys because I cannot overemphasize enough how crucial understanding this is. So let's go ahead and get right into it. You know what I mean? We're going to go ahead and get right into this. So first of all, right, you know, the average person, they go out and start a business, especially first-time business owners. You know, they go out and start a business. And, you know, that's cool and great and wonderful. And they get a little excited. Let me get a little light on this situation here, you know. There we go. The light on the situation. But anyway, as I was saying, so, you know, the average person goes out and starts a business. You know, they spend the $250. They go incorporate themselves in an LLC or a C corporation or an S corporation or whatever. And, you know, they now have a business and they're the CEO and they feeling really good about that. They go get themselves a website. They get themselves some business cards. They pass out some business cards. I'm the CEO, right? You know, or I'm the president, or I'm the president and chairman of the board, or I'm the CEO and chairman of the board, and all of these great, wonderful machinations of titles that you can put together, right? Let me give you some truth. The truth of the situation is those titles mean nothing. CEO, Chief Executive Officer, Chief Operating Officer, Chief Financial Officer, Chief Information Officer, President, Vice President, Secretary, Treasurer, Chairman of the Board, Finance Chair for the board, all of these titles, they really mean nothing. They mean nothing. They are not nearly the most important titles that you need to be focused on, right? The most important titles in a business are shareholder and creditor, period. The most important titles in a business, the only titles that truly matter in a business are shareholder and creditor. That's it. The rest doesn't matter. It doesn't. Because when you are a CEO or you're the president or you are the vice president or the COO or any of those great, wonderful titles, here's the truth. You are part of what's called an executive management team. That executive management team works for the will and pleasure of the board of directors, right? So that means if you're the chairman of the board, that's cool. The senior management team answers to the board. But at the end of the day, the board of directors works for the will and pleasure of the shareholders. Period. So even if you're the chairman of the board, if you ain't got no shares in the company, you work for somebody else. You working for those shareholders. And at any point in time, the shareholders can get together with a majority vote and remove you from the board. They can fire the whole board. They can direct the board to fire the whole senior management team. Period. Ownership is being a shareholder. Bottom line, period. If you're not a shareholder, it doesn't matter. Now, the reality of the situation is when you first start a business, right, of course, you're probably going to be everything, right? You're going to be the only shareholder or the only member if it's an LLC, and we'll get into corporate structure after we get through equity and debt. But, you know, when you first start a business, you're the CEO and you the only shareholder. So you own the company and you know, the senior manager, right? And that's cool. That's great, right? But as you grow and scale, as you begin to grow and scale your business, at some point in time, you're going to need to you're going to need to raise capital. And you're going to do that one of two ways. You're going to do it via debt, or you're going to do it via giving up some equity. And so understanding that the shareholder controls everything is very important, right? So, as I told you, there are only two titles that really matter. It's the shareholder and the creditor. The most important title of these two is the shareholder, period. It's the shareholder. There's no way around that. It's the shareholder. The shareholder owns the business. If you buy one share of Microsoft tomorrow, you are an owner in Microsoft, period. No way around it. You may be an infinitesimally small owner in Microsoft. You may be an extremely small owner in Microsoft, but you're an owner. You own one share, you have a vote. You have one vote. That means when they have their annual shareholder meeting, you're able to show up. And you can vote for stuff. Now, granted, your vote one way or the other probably won't matter because you only have one share. But the fact of the matter is, you have the power to vote. You are an owner. The board is working for your interest. They're working to increase shareholder value. And when they increase shareholder value, if you are an owner, if you are a shareholder, you are an owner. They are working to increase your value, so you make more money. That is the most important part. Now, the most important thing to have in a business is control of 51% of the voting interest. The most important thing you have in a business is 51% of the voting interest. Notice I didn't say 51% of the stock. Notice I didn't say that. And there's a reason why when we get into this in the weeks to come, why it is that 51% of a Class A stock or 51% of a certain stock class or issue may not matter much, right? So we'll get into that, right? And that'll be in the upcoming weeks. But overall, the most important thing you can have in a business is 51% of the voting interest. And that can be accomplished a couple of different ways. One, it can be accomplished by you controlling 51% of the voting shares in the business, right? So if you own 51% of the voting shares, of all the shares that have the ability to vote, right, then you have controlling interest. Well, there's another way you can do it too. That's called direct ownership. What we call that is direct ownership. You own 51% of all the voting shares. You have direct ownership. You have direct control of the outcomes of the business, the direction of the business. If you don't like what, the board of directors is doing, you can fire them and put a new board of directors in place. If you don't like what, senior management is doing, you can force the board to fire senior management and bring in new management. All of these things. Activist shareholders do this all the time. And we'll talk about activist shareholders as we move forward in the weeks that we are going to be discussing this, right? Now, moreover, the other way you can do it is by indirect ownership or indirect control. Indirect control of 51% of the voting interest is what we call a proxy, right? So what a proxy is it's the right given by one person or company to another person or company to act on behalf of them for a specific purpose, like voting in a shareholder meeting. So for example, you might own 10% of the voting interest. And you and your buddies might own, one of your buddies might own 20%, another one of your buddies might own 20%. So altogether, and you might have a buddy that owns 1%. Altogether, you guys have 51% of the voting interest. What can happen here is your buddies can say, here, I'm going to give you a proxy to allow you to vote my shares the way you see fit for the benefit of whatever it is you're trying to accomplish. It's called a proxy. When large corporations go through adversarial actions or what used to be called hostile takeovers, when activist shareholders get involved, generally what happens is it's a proxy fight, right? So they get into a proxy war because the activist shareholder wants to grab up as many proxies as they can to be able to control the voting interest. The management wants to grab as many proxies as they can to be able to prevent the activist shareholder from doing what it is they want to do, which may be adversarial against the board of directors or senior management, right? So, a lot of times you'll hear in the press, proxy fight, proxy war, things like that's what a proxy war is. They're vying for the other shareholders' rights to vote. They want to get those rights via a proxy, right? So now, we're going to have a long, deep discussion about equity and debt and the different types of equity shares, the different types of debt possibilities. There are a lot of machinations that you can put together to get to this, right? But before we do that, we need to back up and we need to get into, I like to back into things, right? So the best way to back into this is to talk about what happens in a corporate bankruptcy, right? Understanding what happens in a corporate bankruptcy will help you understand where you fall if you're a shareholder, if you're a debt holder, etc., etc. And this matters because different positions carry different benefits and different risks, right? So let's talk about it from the worst case scenario. Remember, I always tell you that the goal of investing is to maximize capital appreciation while mitigating its risk to its lowest common denominator. I want to make as much money as I can while taking the least amount of risk possible. And so what you're always thinking about when you're investing in something, especially a business, you're always thinking about what's going to happen in the worst case scenario. So the worst case scenario in a business is they file bankruptcy, right? They go out of business. They're filing bankruptcy. In that situation, you as an investor, either be it as a creditor or as a shareholder, you need to understand what happens to you when they file a bankruptcy. So let's talk about that. So in a bankruptcy, there are priority positions, right? And so you have to understand where you fall in the chain of getting paid in a bankruptcy. So the first people that get paid in a bankruptcy are the people who put on the bankruptcy, the lawyers, the receivers, the trustees, court costs, auditors, forensic accountants, all the people that were parties in representing the company in the bankruptcy, parties that were appointed by the court to manage the bankruptcy or manage the company through the bankruptcy proceeding. All these people get paid before anybody else gets paid, period, right? So the company has to pay its bankruptcy fees first. So when a company goes bankrupt, the first people that get paid are the representatives in the bankruptcy proceeding. They get paid first, period. There's no way around that. Now, after they get paid, the secured creditors get paid. Those are the next people that get paid. The debt always gets paid before the equity in a bankruptcy. There's no way around it. But the secured creditors get paid first. What are secured creditors? Secured creditors are creditors who have loaned money to the business. And what they've done is they have filed a lien against the business to be able to let everyone know that they're owed money. They have a collateral interest in the business and its assets. That's what the lien does. It establishes a collateral interest. So in the event of a bankruptcy, no one else can get paid, or outside of the bankruptcy representatives, until they get paid, because they have a public notice. What lenders and creditors tend to file on companies are what are called UCC-1 financing statements. So what they do is they'll file with the Secretary of State for where that business is incorporated, so that way it is public record that they have a lien against the business. Now, if the business has property, like fixed assets, like a warehouse or certain real estate investments and things like that, what they may even go as far as doing is not just filing with the Secretary of State. They may also file their UCC-1 financing statement in the county where the property is located. Because sometimes what happens is sometimes when a property is being sold, sometimes the title company only checks in the county. They don't actually check the Secretary of State, right? Because it costs more money for them to do that. So when they do their lien search, they're only lien searching in the county. So sometimes if you haven't filed against the asset in the county, it may be missed by the title company, and the title company will dispose of the asset without satisfying your debt, right? So to prevent that from happening, creditors usually file in the state with the Secretary of State, and if it's against the fixed asset, they'll generally tend to file in the county as well, right? So that's that. Now, all lenders, nearly all of them, I'll say nearly all of them, nearly all lenders file a lien against companies to protect their interest. Now, here's the interesting thing about that. Of course, as a company continues to grow and expand, they need to potentially borrow more money. It is not uncommon for large companies to have several different creditors. That's not uncommon. So who determines which creditor gets paid first? Who determines that? So the way it works is very simple. The creditor who filed their lien first is in first position. They get paid first. The only way, and then it falls down the line based on the date of filing. So whoever filed first gets paid first. Whoever filed second gets paid second. Whoever filed third gets paid third. There are exceptions to this rule, of course, and here are the exceptions. The exception works like this. Sometimes what a company will want to borrow money from a really large bank because they've scaled to a point to where a really large lender will take them seriously. But the lender will look at they'll do a UCC search or a lien search, and they'll find that they already have a loan with another lender that's in first position. The larger lender can do one of two things. The first thing is they can pay off that smaller lender, right? And then add that debt to the financing amount or deduct that amount from the proceeds, from the net lending proceeds, right? Or from the gross lending proceeds. So the net will be different from the gross because of the difference between financing and paying off that creditor. Or they can leave them there, and what they can ask the other lender to do is what's called subordinate themselves. Basically, it allows the larger lender to go ahead of them in the payout flow, in the payout, in the pecking order of payout. Most large lenders, if you're scaling and you've got enough cash flow, will just pay off that loan and get it out of the way so there's no complications. Because a lot of lenders don't like to subordinate themselves because they understand by subordinating themselves, they're no longer going to get paid first. They're going to get paid second. They don't want to get paid second. They want to get paid first if things go left, right? There's always... So when a bankruptcy happens, of course, the person in first position is going to get the most money. Everybody else going to get what's left over. They're going to get a distribution of what's left over on down the line until they run out of money. So if they got 10 different liens, we might get to number 10 and there'd be no money left. And so they get nothing. That's just facts. That's just facts of life in bankruptcy. This stuff happens pretty often. So, so your secured creditors get paid next. So now, the third people that get paid are the employees. They fall in the unsecured creditor category, technically. But they're employees. So next people in the bankruptcy payout are the employees. Any owed and outstanding payroll has to get paid, right? So that has to get taken care of. After they get paid, then the unsecured creditors get paid. What is an unsecured creditor? I'm glad you asked. Okay. How many people in here have ever heard of a bond? Or have ever bought a bond? Anybody in here ever heard of a bond or bought a bond before? So corporations issue bonds. What a bond is, they have the ability to basically issue publicly traded debt in the market, right? In the market, like in the securities market, like on a securities exchange, and borrow money against that. But you don't have a secured position. So bondholders are not secured. They don't go and file UCC1 statements or do anything like that. A bond is nothing more than an IOU. It's a promise to pay. That's it. When a company issues a bond, what they're telling you is give me your money and I promise you that I'm going to pay you an interest at the agreed upon times that our agreement says I'm going to pay you the interest, and that's it. And after, however much time, if I'm allowed to hold your money for 10 years, if I'm allowed to hold your money for 5 years, when the bond matures or the debt becomes due and payable, right, then I will pay you the principal. It's like a balloon note. A bond is a balloon loan. That's what it is. It's like a balloon loan. It's like, give me your money now, I'll pay you interest now, and I can hold the money for 5 years or 10 years based on the agreement or less. Sometimes they're a year or whatever. But, most bonds are medium-term, long-term notes. So they go for 5 and 10 years. That's pretty standard. Most go for 10. That's where the 10-year benchmark comes in. We'll talk about that at a later time. But at the end of the day, they pay you interest for 10 years, and then in the 10th year, they're going to pay you all the principal back, right? So you have an IOU. You're a creditor, but you're an unsecured creditor. You don't have a lien against the business. You have an IOU. You have a promissory. You have a promise to pay. That's all you have. So you're unsecured. So you get paid after the employees get paid, right? Now, after all the creditors have been satisfied, all the creditors have been paid, right? The employees, the creditors, the bankruptcy receivers, or the bankruptcy representatives. After everybody's been paid, then the shareholders get paid. The owners of the business get paid. You're the last to get paid. And so, as an owner of a business, you are always the last to get paid in a bankruptcy. That's how it works. And that payout has a priority position too. It breaks down into 2 categories: preferred shareholders and common shareholders. Preferred shareholders get paid before common shareholders do. Common shareholders get paid last. So the stock you buy, when you buy stock on the NASDAQ or the New York Stock Exchange, you're buying common stock. There are abilities to buy preferred stock, but you're buying common stock. So the difference between, and we're going to get into this next week, but in general, there are lots of exceptions to this and lots of different ways that this can work, and we're going to get into all of that. But in general, preferred shareholders get paid out first because they're non-voting shareholders. Usually preferred shareholders are non-voting. They usually get some sort of fixed dividend. They usually have a conversion right, which gives them the right to convert into debt or common stock at a specific stock price. It's called a warrant, right? So, they have different rights, and they lose some rights as a shareholder, like they can't vote. So because they can't vote, they get paid first. Common shareholders in general have the right to vote. They, in general, in theory, every one share gets one vote. But I'm going to show you that it rarely actually works like that in practice. One share does not always equal one vote. And we're going to get into why that is. We're going to talk about excess shares provision clauses, poison pill defense. We're going to talk about, different classes of common stock that have different voting rights and powers and ability. There are a number of ways, and I'm going to give you some examples of some companies that actually operate that way. So, understand that there are what I'm going to teach you, and I'm going to take some questions here in a second, but what I'm teaching you now is the basic overview. What I wanted to cover with you today was kind of the bankruptcy proceeding and how that works and how payout works in bankruptcy, right? I think that's very important, and I think that's a good starting point. Next week, we're going to get into the different types of creditors that you can have and the different types of debt positions that can be taken in a company. There are so many. Like, you can have a note, you can issue a debt, or you can put a credit facility or a loan. You can issue a loan, and that loan can be callable. The loan can be convertible. The loan can do a lot of things. And so you have to understand the difference between callable, non-callable, convertible, non-convertible. There are a lot of things, and the same can happen on the equity side too. Shares generally aren't callable. They can do they can always be bought in the market, right? They can always do a share buyback. But, but on the equity side, you've got to understand stock splits. How do stock splits work? How do reverse stock splits work? There's a lot to talk about there. And so, this isn't a very long discussion today. because what I don't want to do is I don't want to overwhelm you guys with so much information at once, because there's so many things to consider and understand about equity and debt structure. And I want to make sure that you thoroughly understand this part, because this is going to set the stage for everything else we talk about. From setting up corporations, from understanding different corporate structures, from understanding how bylaws and operating agreements work, and then once we get through all of that, then we're going to talk about nonprofit organizations, and they're completely different with the way they operate. So, there are a number of things here. So I'm going to stop here. If you guys have any questions, feel free to ask questions at this point in time, because I want to make sure that, anybody that has questions gets their questions answered and has an opportunity to really, I want to make sure that this is clearly understood what I talked about today. Because I talked about a few different things. I talked about bankruptcy. I talked about, proxies. I talked about the two most important parts of a corporate structure, which is the shareholder and the creditor. They're the only thing that matter. So I talked about a number of different things today. So please feel free to ask questions. I'll be happy to answer them. The floor is your guys' at this point. Okay, so I'm going to assume nobody has any questions. I think sometimes what happens, and I've said this before and I'll say it again, never be afraid to ask a question, right? Never feel intimidated by the content that you feel like you don't want to ask a question because you don't want to sound silly. The only silly question is the one you don't ask. I do this stuff for you guys because I want you to benefit from it. I want you to grow and learn from it. So, and use it to better your lives, and better your wealth position. So that's kind of how that works. So if anybody has any questions, feel free to ask at this point. You know what I mean? Feel free to ask. Okay. I'm going to assume that no one has any questions. So I'm going to end this discussion here. I hope everybody has a great day. I hope everybody learned something today. As always, like, subscribe, share, follow, share this information with anyone that you can think can benefit from it. The more eyes we get on the content, the more people can benefit from the content, and the more people's lives can be touched and be bettered. As always, we hashtag get real woke around here. We hashtag make it make sense. And it's always hashtag for the free. I hope y'all enjoyed today's lesson, and I'll talk to you guys next week. Hold on. I think we got a question. We do. Exotic Bulls Jacks asked a question. You caught me right before I was leaving. Let me see here. It says, when you are an investor in a company, are you able to find out who the lenders are that hold liens? That is a great question. Let me talk about that. So first of all, Exotic Bulls, that's a great question. You don't necessarily have to be a shareholder to find out who the lien holders are in a business, to be quite honest with you. That's not really necessary. There are companies that you can pay to do lien searches for you, and you can search if there are any open liens on a company if you know the company's legal name and the state of incorporation. And if you're willing to pay for it, to be quite honest with you, lien searching companies will search every state. As long as you know the legal name of the business. That's very doable, and you don't have to be a shareholder to do that. Actually, lenders who lend money to companies are not shareholders in the business. But before they loan you some money, they do a lien search to see if there are any liens out there on the company. They're not shareholders. It doesn't require you to be a shareholder to do a lien search. And you don't need permission from the company to do a lien search. That's the interesting thing. There's no law that requires you to get permission from the company to do a lien search. and this is something that we'll talk about. Thank you for that question, Exotic Bulls. It was a great question. And this is something we'll talk about at a later time. But, when you're targeting a company for acquisition, a lot of times what you do first is a target analysis. So, you'll bring in an investment bank, you'll bring in a law firm, and you'll start a target analysis. And one of the things you're going to do is, if they're publicly traded, this is pretty easy. What you do is you pull their 10Ks, you pull their 10Qs, you take a look at everything. Of course, in their 10K and 10Q, you're going to get their legal name. Generally, you're going to be able, because they had to register to go public, so you're going to be able to get their bylaws. And so by getting their bylaws, you're going to see if they have any excess shares provision clauses in their contracts or anything like that. So you understand, what you're going to have to do to be able to acquire the company if you want to acquire the company, especially if it's going to go hostile, right? So there's that. You're going to be able to calculate value of the company. You're going to actually be able to evaluate the business, so you can figure out if you're going to need to do a leverage buyout to do the deal. So there's also that. But as well, one of the things you're going to do is a lien search. You want to know what debt is out there on the company, because, some debt may be off balance sheet. And so, if it's not properly reflected on the balance sheet, you want to be able to see that, so you can truly evaluate the cash flow position of the business. And you can see how efficiently cash flows are being managed, and how well disclosure oriented the business is. So, yes, the short answer is yes, you can do that, and you don't need to be a shareholder to do it. So with that, as I was saying, I hope you guys have a great day. And I will speak to you guys next week. Have a great day.